Welcome to the Buy and Build podcast, the show where we explore the nuances of buying and building small businesses with a focus on the UK and Europe. I'm your host, Paul. If you're interested in buying, building, or investing in UK and European small businesses, this show will dissect the strategies and insights of business owners, investors, and other deal professionals that I meet along my journey to acquire and invest in profitable small businesses. If you enjoy the show, please follow us on your favorite podcast app to stay up to date on all new episodes. And join the Buy and Build community at buyandbuild.co, where I share additional resources, deals, and ideas with the community. You can also find us on LinkedIn at Buy and Build and Twitter at Buy Build Podcast. Welcome back to another episode of the Buy and Build podcast. I'm here today with Brad Nathan. Brad, you're the president of Lynx Equity Limited, a private equity firm that specializes in buying companies in old world industries, so something our listeners will know quite well. And you have holdings across North America, Europe, and the UK, but you're based in Toronto. And I think from our previous chat that you have over 50 portfolio holdings now, which is quite something. And I guess for those that are listening, that have listened to a few episodes, we had Neil Johnson on a while back of Duke Royalty, and he mentioned Lynx, kind of you and Neil from Duke work together, and he kind of referred to it as partners. So I was happy that we were able to connect, and happy that you were able to come on the podcast to discuss your approach, because I think it's really unique and you are executing at a high level. So this is going to be very fascinating. So perhaps, Brad, we could just kick it off with a brief background on yourself leading up to the launch of Lynx Equity.
Sure. Thanks, Paul. Thanks for having me. I want to apologize to everyone. I'm in Greece and I'm at a restaurant. It's a little loud in the background with music, so please excuse me. Yeah, but it is the best place I've ever done a podcast. So I before Lynx, I was the CPA. I hated it. I practiced for about 2 weeks and then left accounting and went to work for a venture capital firm called the Rothschild Canada Limited, which is the part of the Rothschild family. And I was doing venture capital there at around the time of the .com, and none of these businesses seemed to make any sense to me. They were all zero revenue and $100 million valuation. And that was the discount because their competitor was, $200 million valuation. And they were going and comparing themselves to each other, and they were both insane. So you compare yourself to one crazy company, it just seemed like a funny model at the time. And I was always interested in small business and entrepreneurial, I think since I was a kid, doing all the things that entrepreneurial kids do, from lemonade stands to delivering papers to selling chocolate at school and installing peepholes and doors legally. It was called ICU peepholes, and I would drill them in the front of people's doors, and I just love them. I just love being an entrepreneur, and I saw kind of a hole in the market, which was that no one was paying attention to these old school businesses like what we ended up getting into, and there was a real need for this in the market. So I left and started Lynx, and I think about 14 years later, we're here. Excuse me, I didn't make a salary for the first 10 years, and I lost hair, and my first deal was a fraud, and I've never experienced people like that. It was a real eye opener to the world. I got my Harvard education in my first deal, and then some. So fast forward, we're 51 companies with over 60 deals because we've integrated some of them into others or amalgamated them. And we're closing in on, if everything goes well, by the end of the year, end of the fiscal year, which is July, we'll be kind of close to 600 million in revenue and EBITDA of about 51 million. So it's a big change from the beginning when I started out.
Awesome. That's incredible. And I think you touched on kind of some of those earlier deals, things didn't go according to plan, and you've obviously overcome that to a good extent. Maybe just talking about that investment strategy, what is it at the moment, and how has that evolved over time?
When we started out, our first deal was less than 100%. We bought a business where we owned 70%. And if there's one piece of information that I can kind of pass over to the listeners, it would be, it's very different model if you own 100% or if you don't own 100%. There are two very different approaches to what I do, or what you could do. I ended up in partnership with a guy who was a scumbag, and next thing I know, not only was I dealing with him as an employee, but I was also dealing with him as a partner, and it was devastating, truly. And when I said I lost hair, I lost 2 clumps of hair on both sides of my head. That's my hair never grew back. That's how stressful it was. And we ended up settling, and he was a fraud. So we ended up getting the shares for basically nothing. But it was a year's worth of litigation on my first deal. And, I put my arm around him to do a deal, and he put a knife in my back. And strange behavior from someone you're trying to help out. But in that case, we owned, as I said, 70%. That changed our model that we only do 100%. And people say, would you do 90? Can you do 85? They want to have the manager wants to have some equity. And we said, we see enough deals where you can do 100% that we don't bend. But we've also learned how to do a lot of bonus programs and compensation plans where the owner or former owner or manager or new president or whatever it might be can have some kind of incentive program without having to make an investment. And we've done quite well with that. It works with our model.
Right. Yeah. Yeah. I think, like you said, you see so many different strategies and I guess different strokes for different folks. But that incentive piece for management is always one that intrigues me, because I think depending on how actively involved and how much you want to be as an operator, and it seems like you are more of a maybe capital allocator at this point, having that incentive structure in place is quite an important piece of the puzzle.
It really is. And it works, from either an earn out for the seller, where they might be able to get a little bit of an increased purchase price with better performance, to, incentive hurdles for the presidents where they're running the business and, they might get an extra bonus of, who knows, depending on how well they do. But, we set a target for them to hit. And if they hit it, they get X dollars. And we love paying it because it means that they've done really well.
Right. Right.
I can go into detail of that if you want, or whatever you want.
Yeah, I would be curious. So maybe in terms of the outgoing owner and I guess the president, maybe that's someone that you put internally. Is that how you define it?
But, the perfect situation is that we can hire a second in command to take over for the president. And what we do is if we buy the business with $1 million in EBITDA, we'll give the say 25% of anything above that number. So if he delivers $1 million for an EBITDA versus $1 million, he gets 100,000. It seems to work for us. It's not perfect. There are definitely flaws in it. There's a real, they could basically spend their way to get that EBITDA with more equipment. So we've changed it to take CapEx into effect. They could definitely not replace equipment in order to have a better number. But, for the most part, we're dealing with hopefully people with great integrity, and you get screwed sometimes, but for the most part, the model works for us. It's basically anything above our hurdle of what the purchase price EBITDA was, they share in that in some fashion. Okay. And they've never really had that, right? They've never really had that situation, so it's new to them, and it's kind of like a little bit of a dreamland for them too. And we always let them invest in the parent company, so they can always invest in Lynx. Okay.
Fascinating. Yeah, I like that. And you mentioned an earn out for the outgoing owner. Is it most cases a retiring owner? And if so, how do you, because I find something that can be a difficult conversation. They normally are up for a transition period, but not really an earn out. I guess your deal flow, you could be a little more selective, but how do you navigate that conversation?
I used to be afraid of bringing that up because they could say you own 100%, I'm not in control, but I'm not afraid of that anymore. If they say no to an earnout, then we'll probably say no to the deal. And that's okay. Truly believe it's a numbers game. For anyone listening, it's not about getting, looking at one deal and being able to do that one deal. You have to set your parameters of what is acceptable to you and go with that. Don't change your mantra because something doesn't fit. We will definitely not bend ours. And the key for us is, if one guy says no, we swipe and we find another one. It's like Tinder for business, right? Not everyone's going to fit what you're looking for. And that, I think that is one of the keys to our success is, we probably look at a few thousand deals a year and we say no to 2,995 of them, right? So as long as 5 of them fit our mold, we're thrilled. But not everyone has that deal flow. But, I've been doing this for, I don't know how many years anymore. We had a little fund before Lynx. So we'll call it 20 some odd years. We built up a network. So I'm in the fortunate position to do that. And what's funny is I remember this one guy coming to me saying, I've looked at 200 deals and I haven't done one yet. And I remember saying, you're not for the most part, the companies are not the problem. He's the problem. We found a problem in every business. Finding a problem in every business is not our issue. It's the structure that is. We make sure of. We make sure that we buy 100% from someone who's retiring and have some portion of that as an earnout. That's our kind of mantra. You'll find a business with one customer as a large piece of the concentration. That's okay. You just have to do the deal around that. It's not like you ever see a bad company. You can do a deal with every single company. If you do a good deal or not is the issue, not if it's a bad company. We bought one company with one customer represented 95% of their business. And we structured the deal to be commensurate with that. We paid 2 times EBITDA with half down and the balance over 2 years. And we set it out to make sure that we had a 60% IRR, and that was what it was worth. If you have a company with huge diversified customer base, you're going to get a lower IRR. So you have to understand the metrics that you're looking at. That's the key to the valuation. Is seeing, it's not that you can't do that deal. It's just that you have to structure it to be commensurate with the risk. And he took an earnout. And if he said no to that, we would have said, okay, thanks a lot. Next.
Yeah, I think so. Obviously, deal flow plays into that. But to your point on kind of structuring, I guess that's more of it becomes a bit of an art at times, and getting those deal reps in is always going to help you get that creative flair going, I guess, a little bit.
Yeah, it's not like we're a bank where, a bank client and they can risk rate you perfectly. We have a very broad risk rating in the way we do things. So, but we're creative, and you have to have some entrepreneurial spirit in this, because, part of it really is art. Part of it really is art, and part of it's the science.
I guess that's what makes it interesting, right? It's kind of every deal is different. Kind of you hear of these people that have become a bit of deal junkies. They just want to get a deal done, and I can see how that's a thing, because as an optimist, I find that I'm always looking at a deal and figuring out what would be a creative way to get this deal done, rather than, maybe I should be more strict on why this is not a good deal and move on to the next one. But I always kind of start thinking creatively, like, maybe I could just structure like this, at this price it could work. And so I think I suffer from that a little bit, to be honest.
Listen, it depends on your desperation level, and it also depends on your ambition, on your risk tolerance.
Yeah, I think everything relates back to risk. I think this is the hugest piece. And that's why I get carried away with the structuring, because I'm always kind of trying to balance those two things. Probably to an extent that it's overkill.
I mean, listen, we're at a point now, people screw up when we have 50 different businesses and we're doing, let's say, call it 51 million in EBITDA with 51 businesses with oddly 51 in EBITDA. Oh, by the time we close, excuse me, 53 businesses with 51 million in EBITDA. I'd be a fool to do a deal that would put any of that in jeopardy, right? I'd be a fool to buy one business doing 50 million in EBITDA to double and risk the whole thing. That's where you really screw up. There's these companies, a lot of people feel I have to get bigger and bigger and bigger and bigger so fast that you risk the whole ship. And I would never do anything to risk the whole business. That's where foolishness comes in, or ego, or I'm not sure what it is, ridiculous behavior, for lack of better words, where someone's willing to blow the whole thing to have an extra little bit of profit on there. And for me, I love the game of what I'm doing, and I can't lose anything for my investors. So I would never do anything to jeopardize it. We'll grow by more acquisitions, we'll grow by doing more acquisitions of the same size business versus doing one large acquisition. And that's great for us. If we made more money, I'm just going to have a nicer t-shirt, maybe. Like, I enjoy my life and I'm not going to screw it up by, I don't need that extra money to be able to wear a better, truthfully, that's probably what I would do. I'd buy like a really nice t-shirt line. I don't need a Ferrari. It's not about getting a Ferrari. It's about maintaining my business is my Ferrari.
Yeah. No, I like that. So maybe on that point then, thinking about kind of portfolio construction and how you're building that out. So it sounds like roughly each business is around $1 million in EBITDA. Is that the kind of target level that you're looking for each acquisition? Or I guess there's some flexibility there. And then maybe as that grows, each of those grows to, like, say, 2 million EBITDA per business just from organic growth, then you'd look at each acquisition being 2 million to kind of keep that scale.
Right. I mean, we're looking at kind of 1 to 3. It just happens to average out to $1 million, but there's a lot that are much smaller and there's a lot that are much bigger. Yeah. I think our biggest is about 4 million in EBITDA or 5 million, but our perfect deal size would be 3 million in EBITDA. 2 to 3 would be our perfect deal.
Okay.
And as we grow, we'll probably just stay with that number.
Do you want to talk about some of the sectors? Because obviously with 50, I think you said 53 holdings now, that's quite a few, but it feels like scanning the portfolio quite quickly, there's a few verticals that you focused in on. Do you mind talking just about where you're focused, why you like those sectors?
We're focused on flooring, signage, and lumber not focused. Our largest sectors are flooring, signage, and lumber. And the reason we focus on that is because we have a number of those businesses. So it's a little bit of a circular discussion. We don't focus on flooring because it's such a special industry. We just happen to have a few that came up. A couple of people called us when they heard the news and they were in the same industry, and it kind of gained its own momentum, had its own life. And because of that, we continue to focus on that. So the success bred the success. There's nothing particularly special about any of those industries other than we're able to do very, very good due diligence because we understand the business as much as the seller does. We can call on 7 different presidents to look at a business and they know it as well as the guy selling it, which helps a lot. It helps a lot. It really does, as opposed to going into a new industry and learning it. But once you do that learning, then the next one is easier. But we would never have a focus where we're just buying those businesses. I think that's a mistake.
Okay. So you look broadly like, I guess agnostic is the term that gets thrown around. You'll look at any deal that's a good deal as an investor, but you kind of tend to have your area of focus where you have your expertise.
Exactly. However, having said that, we will jump on an opportunity if it comes in the floor, signage, or lumber space. But again, it's not because of anything. We're not only doing that, solely doing that. Excuse me.
And so, just like let's take flooring for an example, because for some reason, maybe I signed up for this a while ago, but I get a lot of small deals. There's a lot of small flooring companies in the UK. You probably know that, having exposure there. But what is the smallest that you would look in as as a small tuck into your other entities in that sector?
That's a good question. Probably, 250,000 euros EBITDA. But again, it depends on, we have a business in Seattle and we want to get more, it's 3 hours north of Seattle. And if they have an employee base, we would do that just because it's ineffective for us to service that space without that company. That would be an example. So it depends where it is. If it was a new company in another state and had a 250,000 EBITDA, we probably wouldn't do it. So again, it depends on location.
Okay. So you touched on earlier kind of it wasn't easy to get to where you were, I guess is the high level summary. There's been a lot of ups and downs, I guess, but, and I appreciate that honesty because it can be, it like you're sitting in Greece now, you're having a great time, but it wasn't without hard work. So how do you now manage the business? Like if I think of 50 odd companies, that's almost one a week if you were going to devote attention to one company. How do you kind of think about that sitting at the top of Lynx Equity? Like how is the management team structured kind of per business and then kind of within Lynx Equity? How is that designed?
Yeah, you ask good questions. We've set it up similar to a bank where a bank manager has, a certain number of accounts and he or she manages those accounts. And when they hit, 20, they say, okay, I can't handle anymore. And they hire a new account manager. We're a little bit like that. We've debated internally a lot about how to structure that. And part of it is, should you focus on each business as a segment or an industry specific focus where one guy just looks after signs, one guy looks after floors, they have their monthly budget call and assuming everything's okay, they go on with their day. And then we've also thought about structuring it we've also set it up structuring it in, who needs the help the most. So we have our own little, for lack of better words, special loans department run by Judith Benatar and my partner. And she doesn't get rid of anyone. She tries to keep the staff and fix the business without having layoffs. And she turns over every single nickel and turns things around. All the confidence in the world in her. And she's been great with that. And her focus is the problematic businesses. And when something's gone awry, overseer of everything, Marvin, and then Europe is handled by the individual account. I say account manager, but Europe is handled by Sophie and Ashley, where they look after their respective countries because they're not of the size yet to require a full-time manager. But that is a huge that is a huge aspect of development that we're working through right now. And then in some cases, some guy like Eric, for example, Eric Percy, who's head of M&A for North America, is able to focus on the flooring businesses because he has such an understanding of them, as well as overseeing other acquisitions. And he also works on managing that company and the reporting because he understands it. He understands it intimately and better than I'll ever know. I'm very good at hiring people smarter than I am.
Okay. So strong team.
Fantastic team.
Yeah. Yeah. I mean, I guess that's a key skill set, right? And I think obviously that developed as you scaled, but I think, just being able to unpack that a little bit is really, really helpful. So perhaps we could go a little bit more granular now. So
if I could say something on that.
Yeah, go ahead.
If I could just say one more comment on that, when we haven't had turnover in 2 years and a hint that I could give anyone looking to buy or to follow in my footsteps, not excuse the arrogance on that. If there's anyone looking to do what we're doing, if you have a company where there's a significant amount of turnover, you have a problem with that president. Every time we've had a problem business, they have huge turnover. And it generally means the president has done something wrong.
So yeah, I just wanted to get a little bit more granular. So obviously we've taken a bit of a high level view at the moment, and we touched on a little bit about structuring deals in terms of the earnouts at 100% equity. And I wanted to ask a little bit more about the debt equity split given the link to royalty financing. So that was obviously a unique approach to financing deals. I'm not sure if you do every deal like that or if it's a portion of the deals, but I just wanted to get an idea of how you're structuring those deals from a debt equity split, and is that debt component, kind of royalty finance-esque, or, just a little bit more about that.
Right. So, the general rule when it comes to raising capital is that if someone offers you money, take it. When we had that approach, people are worried about a point here or there, but that's a zero consequence to us. It's about availability. We're making plenty on our deals, so the more capital, the better. We do have some guidelines, and we don't just give out 30% money, or pay 30% money. We have a very good mixed bag of various providers of capital, from pure debt to some equity in Lynx, royalty financing, vendor financing, bank financing. So we have across the board. The royalty financing is a little bit more expensive, but it's super flexible. Long-term capital that without a it's basically indefinite capital. You just pay a yield on it. And that's important to us to have that, quasi-permanent capital base without having to, be public. I never signed up for raising capital for a living. I never knowingly signed up to raise capital for a living, but effectively that's my job. And I'm good at it, but I don't love having to ask people for money all day long. I can do it. And I do. We'll never want to do that. And if you're going to get into this industry and grow a fund, you better be able to ask people for money. It's not charity. It's providing people an opportunity. And, I had a partner that couldn't see the difference. So he never asked anyone for anything, and it didn't work out. I have other partners that really focus on raising capital, and they make good money out of it, and they're thrilled to be able to do it, and they're very good at it. So you just have to be able to be prepared that if you want to grow your business, capital is a big factor. Yeah,
no, absolutely. I couldn't agree more. I've seen that kind of in my experience diving into business buying for the last few months, but from my previous life in banking, that's an absolutely critical skill. Mm-hmm. So for those deals or portion of the deals where it's kind of more vanilla debt, typically the banks will want to see, I guess in your case, you could leverage your portfolio, but they do want to see some kind of equity component. Are you looking to reinvest cash flows then to a significant extent? Or
exactly right.
Because you said there's a distribution component. Right. Okay.
Yeah. So whatever capital we have available to us, that's kind of our own little free cash that we've learned over time. We use that capital to be part of our purchase price, and that's our form of equity.
Yeah. No, that's fair. Okay. All right. But that's already helpful just to kind of get a sense of that. So I guess, you've walked through the portfolio, the kind of verticals you're interested in, how you're structuring deals, the importance of fundraising, the scale of the portfolio. So what are the future plans for Lynx? Continue to build the portfolio, I guess, but do you have plans to publicly list? Do you ever sell any businesses?
No, we don't really sell anything, other than in special circumstances, which is we're really one-off, so it's not worth talking about. But we have a couple investors who want us to go public, and we recently had a strategy session, and at the beginning of the strategy session, I said, we could end it now by just continuing to do what we're doing, and we're very lucky to be in that position, or hard work begets luck, but we're very fortunate to be in the situation where we can grow and continue to do what we're doing and be great. if we do the same thing. Just keep doing the same thing. We have a really good management team, a really good capital, really good deal opportunities, great investors. So the answer is to just keep doing what we're doing. Nevertheless, we still had a 5-hour strategy session after that, and that's to see if we can do things better than we were doing. But nevertheless, we're in a good spot, and I'm really appreciative of that, especially considering how hard it was in the beginning.
Yeah. I mean, obviously you're executing at a very high level, but appreciate that it wasn't always like that, and kind of, you had a few bumps in the road early on. So that's I guess motivating for people like myself and others listening that maybe are about to close on their first acquisition, or just done a hand for thinking about how to scale things further.
Right. I mean, the answer is don't ever stop, and failure is not an option. That's the easy answer. Yeah.
No, this has been a fantastic discussion, Brad. And for those listening, this has been the second time around because we had technical issues the first time. So I really do appreciate you taking the time to go through a lot of these. Is there any way that I can be helpful, the people that are listening can be helpful, whether it's, I don't know, passing on deals your way? Because obviously you're pretty global, you're pretty acquisitive, and it seems like you have a pretty broad network. I'm happy to give you the mic to leave any message you want with the listeners, or any way people can reach out. Feel free to speak about anything you wish.
I'm always looking for good wine suggestions.
Cool.
And, listen, deal flow is always helpful. The more, the better. We're always looking for great investors who like making monthly yield. And that's about it. I try and give more than it takes. So I'm pretty good. But thank you.
All right. Well, thank you. Appreciate your time. Cheers, Brad. Thanks for joining us for this episode of the Buy and Build podcast. If you enjoyed the episode, please follow the show on your favorite podcast app to stay up to date on all new episodes. If you'd like to support the show, please share it with others you think might be interested.
You can also join the Buy and Build community at buyandbuild.co, where we plan to share additional resources and ideas with this community. You can also find us on Twitter at Buy and Build Podcast.